Good morning, everyone. My name is Adam Livingston. I am the Bitcoin Wizard, your number one source for Bitcoin and Bitcoin Treasury Company analysis. Welcome to Metaplanet's Bitcoin Torque. Japan's yields are so thin a vampire would starve. That lets Metaplanet sell preferreds with polite little coupons to income tourists who want a monthly check and a nap. Then they take that money, buy Bitcoin, and let compound interest do crimes against arithmetic. I was already bullish on Metaplanet because of their ability to get BTC yield by diluting the common stock, but this is getting me so giga-bullish, I almost can't put it into words. The flywheel is rude. Yield buyers get their tea time dividend. Metaplanet gets more BTC, the coverage thickens, risk spreads tighten. The next tranche prices cheaper, repeat until your broker asks if your account is laundering physics. They're capping the dividend load so the machine survives the bear market seasons. Preferreds are going to keep stuffing Bitcoin in the vault even when the stock's premium is asleep on the couch. When the premium is going to wake up, the common equity is going to pour gasoline onto the same fires. So, pretty soon here, we're going to have two engines with one direction, up. This is permanent capital dating an apex asset. This is a thermostat for capital allocation, warm enough to harvest premium, cool enough to keep the coverage clean, and income folks are going to get paid to sit. Bitcoin does the cardio over the next decade. Equity holders get torque. All right, class, today we're going to learn how Metaplanet turns sleepy coupons into cardio for your portfolio. Torque, in English, is how fast equity in Bitcoin grows for each unit of capital that you throw at it. Think of it like horsepower for the company's balance sheet. More torque equals more distance per gallon of money. So there is a scoreboard for how you can value these companies, right? There's BTC yield, how much new BTC per share shows up in a period. There is BTC dollar value, you know, what the hoard is worth in fiat terms, like how your uncle asks at Thanksgiving. But what we're talking here, I really want you guys to remember two specific things. BTC Torque, growth in BTC equity divided by the capital used. Right here, this formula. That is your efficiency meter in a way. If it climbs, your future self gets cocky. So there's BTC Torque. Make sure that you understand it. The second thing I want to focus on in this presentation is the BTC dollar income. So that is the USD value of unrealized gains on Bitcoin acquired with specific financing, net of associated dividend or interest cost, then multiplied by an efficiency factor. Now, the reason why the preferred stocks are the funny part, the fun part of this entire operation, is because the coupon on them is a small fixed obligation. Everybody knows the return on Bitcoin is wild and feral, and as long as the average BTC return beats that small fixed coupon over time, the spread compounds over a number of years into ridiculous numbers. The preferred buyers get their money to buy their groceries or their drugs or whatever they want to buy. The common equity gets the animal spirit. Premium on the common stock can nap and it still works. That's correct. The MNAV of the common stock can go to 1 and this still works. Preferreds do not care if the market is moody. They buy Bitcoin, they pay a set coupon, and then they let the time do the cooking. When the premium wakes up, the common stock just pours gasoline on the same fire. So a simple mental model, right? So you can understand. Imagine a quiet 5% coupon slowly feeding a loud BTC treasury. Every year, the coverage gets thicker. The risk spread tightens, which means the future tranches of the debt price cheaper. The machine accelerates while pretending to be boring. If your financial advisor ever tells you this is too risky, ask him which is riskier, a capped dividend load that gets easier as Bitcoin inevitably grows, or a bond fund that cries when the 2-year moves 50 basis points. Torque is not a slogan, it is the math that bullies time. Remember, folks, BTC Torque and BTC dollar income, these are the two aspects of the operation that are going to illustrate the power that Metaplanet is going to bring to the shareholders. Now, we got to talk about why Japan is the right battlefield, folks. Why Japan is the perfect situation for all of this. Picture a global buffet of money. Japan is the table with the little sign that says, "Please take as much cheap funding as your conscience allows." The yields are tiny, polite, and apologetic. That means preferred coupons can be set low enough to make a monk yawn while Bitcoin does interval sprints in the background. You know, the demographics help in Japan. A nation of savers wants income they can schedule next to their tea. Preferred stock is the perfect costume for these people. It looks like safety to the income crowd, but it behaves like equity to the capital structure. And it quietly feeds a Bitcoin treasury that does not respect calendars. The mechanism is simple. Yen in, the coupon is out, and then Bitcoin on the balance sheet. As BTC appreciates over the years, the coverage of the Bitcoin against the outstanding debt just widens. The credit risk is therefore smaller, then the future transfers are going to price cheaper, and that just means the machine accelerates. We're going to look at some graphs that demonstrate this very soon. So the income buyers keep getting their stipend, and then common equity keeps getting the torque. So we know that strategy is already doing this in the US to great success, and they're doing it where the cost of capital is more of a jealous god. Higher base rates mean fatter coupons, which crush the spread that feeds compounding. This 1.5, that's a trampoline. You jump once and you're going to keep bouncing. So the point that I'm making right here, if the US government bond is paying a 4.2% and strategy is paying an 8%, 9% effective yield, 9 is about double 4.2, 4.5 in that range. Remember that, double. In Japan, if a JGB is paying a 1.5% and Metaplanet can come to the market with a 6% coupon, that means that the spread is 4x versus what you'd get from the Japanese government bond. Am I making sense? Am I illustrating why this product is going to dominate in Japan? Yes, risks exist. The yen can wobble. The Bank of Japan can change its mood. That is why issuance caps, coverage tests, and tranche staging matter. Structure keeps the engine alive when the weather turns. This is financial jujitsu, folks. Cheap yen hugs an apex asset and uses time as leverage. If that does not make your inner bond fund feel nervous, it should. The joke is that the safest looking capital is about to finance the scariest upside on earth. So time for the hardware. Preferred stock is the tuxedo that looks safe to grandma, yet secretly deadlifts Bitcoin. It is senior to common, junior to debt, usually perpetual, pays a fixed dividend, often callable, often cumulative. On the balance sheet, it counts as equity. In the real world, it behaves like a bond with some attitude. The income tourists are going to get a predictable check. The issuer gets permanent apex capital that never asks when to be repaid. So why this matters for Torque? Remember, kids, the coupon is small and boring. The Bitcoin return is elastic and will go up in perpetuity. As long as the average BTC performance clears that coupon over time, the spread is going to compound like crazy, not by magic, by accounting. The income buyers are going to sip their tea, and the common equity holders like me are going to drink rocket fuel. So there's a very simple flow, folks. You're going to issue the preferreds, you're going to buy the Bitcoin, you're going to pay the coupon, you're going to let the time pass and just watch the coverage thicken. And over time, this means the thicker coverage just makes the investment safer. That means a better credit rating. That means cheaper paper. That means more BTC, which further thickens the coverage. This is why bond tourists end up financing the upside that they don't even believe in. So let's do some tiny math, simple math to make it real for you. Let's say you raise 100. And then you pay a 5% coupon on that 100. And then you go buy Bitcoin. If Bitcoin is up 30% in year one, the asset is now worth 130. Then you pay the 5. The net value created above the claim, 130 minus 5 is 125. That 25 accrues to the common stockholder. The coverage on the preferred stock is now 130 over the 100, which is comfortable enough to make a risk manager blush. In one sentence, the preferred is going to hand steady cash to people who like their naps and use their money to buy an apex asset that refuses to nap. So we're getting some framework and some principles from Metaplanet management. Thank you guys. Let's go into the guardrails that are going to keep this machine alive into the future. Everyone loves upside until the chart goes full horror movie. Guardrails are how Metaplanet keeps compounding while the market screams into a pillow. Have you seen the sentiment on X lately? Yeah, I think we all have. First, the cap. Preferred issuance targeted around a quarter of the Bitcoin net asset value. That limits the dividend load on the company so a bad bear market doesn't turn into a margin call cosplay. You want torque, not financial suicide. And because if you are a buyer of Metaplanet, you probably understand that coin is inevitable considering it's a leveraged bet on Bitcoin. If you don't understand that Bitcoin is the risk-off asset, you're not going to be able to handle the volatility of a leveraged bet on Bitcoin. So sorry, this thing probably isn't for you, and that's fine. You can sell your shares to me. So anyway, as we wait for Bitcoin to appreciate into the future, that means the perceived risk of the preferred stock shrinks through time. The dividend is going to stay the same, but the collateral base gets larger, so the bond tourist keeps sipping tea while equity quietly sharpens knives. So let's do a stress drill, okay? Let's imagine that Bitcoin just totally faceplants, the coverage tests, and the issuance cap keep the preferred coupon backed. The coupons are still going to get paid. Yeah, the compounding might pause, but then it's going to resume when the store clears. This structure will allow you to survive the bear market and then feast in the bull market. Simple, savage, and effective. And then, of course, you gotta stage the tranches of the debt. You don't want to go with one giant bite. There's multiple small issuances laddered over time. If spreads widen, slow down. If spreads tighten, accelerate. This is a thermostat, not a slot machine, folks. And you know, the structure just helps. The cumulative dividends queue instead of totally detonating. There's no margin loans against the Bitcoin stack here. There's no pathways to forced selling. Liquidity buffers exist for coupon safety. Think boring cash that pays the bills while volatility does somersaults. The bottom line, torque without guardrails is a stunt video. Torque with guardrails is a Bitcoin franchise. The goal is not to look brave on a green day. The goal is to still be alive, over-collateralized, and a little smug after the 10th red one. Here is the machine in 4 rude steps. Number 1, sell preferreds in Japan. Tiny coupons. Everyone gets a comfy income care. Take the proceeds, go buy Bitcoin because it's going up forever, Laura, and then you're going to run a boring income program that pays the coupon and keeps the lights on. It's not boring, I'm just joking, but you know, I gotta have some flair here. As Bitcoin appreciates, the asset coverage thickens, credit looks safer, then the next preferred tranche prices cheaper. Repeat until your broker asks if gravity still works. Think of it like this: polite coupon out the door, feral, rabid Bitcoin price appreciation in, and then the time in the middle is just cooking the spread. The spread is the whole game. Remember anything from this video, that's what it is. The spread over time is the whole game. And like I said, I'm going to show you this in the graphs coming up here. That spread is the BTC average return minus the coupon overhead. If that stays positive for years, and I think anybody with a brain thinks that it will, compounding does unspeakable things to the common equity. And why does this accelerate is because the fixed coupons do not scale with the BTC because they're fixed, but the collateral does scale with BTC. That's because BTC is the collateral. Each block mined is another millimeter of padding over the same dividend. Safer look, tighter spreads, bigger capacity, more BTC. It is a feedback loop in a suit with an orange tie. One line to remember, folks, one line here. Compound leverage is not leverage with fireworks. It is leverage with patience. Small coupons feeding an apex asset year after year until the math bullies your disbelief. Now, here is the trick that breaks brains. Metaplanet can grow BTC per share whether the market loves the stock or treats it like a raccoon in a necktie. When the market premium on the common stock is rich, that is harvest season. Sell a little common stock at a premium, take the fiat, buy BTC, increase the net asset value and let the MNAV do the heavy lifting. The equity tourists get a shiny story, the treasury gets the coins. Everyone pretends dilution is a love language because the premium more than covers it. Now, when the premium is sleepy or rude, preferreds just take the wheel. No need to beg the market for a premium, the math still works. It is like lifting with straps. You move the weight even if your grip is tired. This is a 2-engine plane now. That's right, a 2-engine plane. Not one, we are adding tools to the tool belt. The preferreds provide base torque that do not care about market sentiment. Common provides opportunistic delta when the crowd gets frothy. If the premium sparkles, throttle the common tap. If the premium sulks, throttle the preferred tap. Either way, BTC per share keeps climbing over time. The destination is the same, the route depends on the weather, and Metaplanet just paved the second road. So now we're going to look at the BTC dollar income sensitivity analysis. Let's go back and review BTC dollar income real quick. So going back to BTC dollar income, that is the USD value of unrealized gain or loss on Bitcoin. Think of it as your investment income. So looking at the sensitivity analysis of the common shares here, as you can see, with different Bitcoin annualized rate of return scenarios coupled with different MNAV valuation scenarios, you can see the BTC dollar income. Wow, magically, it goes up. Shocking, I know. But here's the thing that you got to pay attention to. Below the common shares table right here is the non-convertible 5% dividend perpetual preferred shares table. As you can see, the Bitcoin dollar income amounts are static all the way across different MNAV scenarios. In other words, we don't care what the market is valuing the common stock at. We're still going to buy Bitcoin. We're still going to get Bitcoin dollar income. We're still going to get that juicy Bitcoin torque. So remember, the BTC dollar income, that is what we're all about here, the unrealized gain on the investing in Bitcoin now versus in the future. You can see how much it grows. I want you to look at the orange here. The orange is the BTC dollar income. This shows you the power of the leverage. The inputs that they have here on the table are 100 million in BTC capital. The common stock trading at a 1x MNAV, not that it matters because remember, the preferreds generate the same BTC torque agnostic to MNAV. So we got 100 million in Bitcoin and this is what we're getting back. The key outputs, we're getting 1,379 million BTC NAV. Said more elegantly, that's $1.379 billion. Do you like putting in 100 million to get back almost 1.4 billion? I do. This is going to come out to $1.229 billion in BTC dollar income, which is this big green orange bar right here that just looks so glorious. This situation here, the 30% BTC ARR over 10-year duration, this is what it gets you, a 27.6x BTC multiple and a 13.3x BTC torque. And you got to remember too, this is only on 100 million of preferreds, but they're authorized to issue into the billions. So you can kind of start to see where this is going. How can you not be? You take on debt in fake money, buy the best asset ever, watch it go up forever. And I mean, how can you not love this? And I'm just going to cycle back between the 1x and the 3x charts here because as you can see, it doesn't even matter anymore. When you're talking the preferreds, that bar stays the exact same size. Your BTC dollar income that you're generating on your preferred stock issuance stays the same. So imagine building a polite income theme park on top of a volcano. The theme park sells snacks and souvenir dividends. The volcano is obviously Bitcoin, and this right here is the Bitcoin-backed yield curve. So the mechanics first, Metaplanet can ladder preferreds across short, medium, and long tenors, some fixed, some floating, all mapped to Japan's rate curve. Retirees want monthly payers, issuers want 5 to 10 years, banks want floaters that they can hedge in their sleep. Everyone gets a chair, Bitcoin's doing all the deadlifting. They are going to build out the Bitcoin-backed yield curve in Japan. And if you look at the little dots here that are grayed out, those are other credit instruments that they're going to be able to offer investors who have different risk profiles, different yield needs. The first two on the horizon are the Class A, the Senior Fixed Dividend Perpetual Preferred, which is a fixed and a guaranteed dividend that is cumulative and no conversion optionality. The second is going to be a Fixed Dividend Convertible Perpetual Preferred, so kind of think of like a strike from Strategy in the sense that you can convert it once the common equity just goes to the moon. And then you're going to get a little bit of income on top of that beautiful, happy story. A long duration junk bond like is probably going to be the equivalent to a Strategy Stride. And then eventually you're going to see credit issued from the lowest volatility with a very stable price to medium duration corporate credit. They're going to be able to offer anything to whoever wants it. Here is the stack. Bitcoin NAV, the parts that actually lifts the building. Think of it like the engine block full of angry honey badgers. Above that, you may see any legacy debt or bonds, small and quiet if present. Then come the preferreds, the polite vampires who sip a fixed dividend and never ask for a ride to the airport. And on top of that's going to sit the common equity, the thrill seeker that takes whatever is left after everyone gets their little snack. So why this order matters? Because the preferreds are senior to the common stock, so their claim is predictable and the nerves are calm. The preferreds are going to look safer and the common's just going to eat up the torque for dessert. The building gets heavier at the bottom while the rent upstairs stays the same. So this is the whole trick with no additional garnish. If you keep the spread positive, if Bitcoin's long run return minus the preferred coupon minus overhead, you have nothing to worry about. This is going to generate incredible shareholder value under that proposition. If you keep the preferred program inside the hard gap per guidance, and the dividend load stays tame, you're going to let time just bully the balance sheet while the income tourists collect their monthly money. The beauty is in the indifference. The common equity can harvest the premium whenever the market decides to give it the premium, and then we're just going to keep stacking Bitcoin regardless of whether or not the market is grumpy. Either way, the treasury is going to get heavier while the coupon stays the same size. So across all the slides that you just saw here, you saw the same loop wearing different outfits. Japan supplies tiny coupons to the yield-starved citizens. Metaplanet comes in and issues preferreds that are 4 times as good in terms of yield paid, and then they're going to convert that into permanent, pristine capital. Bitcoin turns that capital into a growing base of collateral based on the appreciation over 10 years. The funding costs fall, the capacity expands, the guardrails are going to keep the engine alive during the storms, and then the premium agnostic design of this financial engineering monster is going to let the plan work in any market mood. That is why I am giga bullish on Metaplanet, folks. You thought I was bullish before? Think again. This is not a meme stock, folks. It is a patient machine that pays strangers to sit quietly while it accumulates the hardest asset on earth and lets time do the violence. My name is Adam Livingston. I am the Bitcoin Wizard. If you enjoyed this content, please like this video, subscribe to the channel, and you know what? Share this with your family and friends, because at this point, this is a moral and ethical imperative to save them from fiat currency destruction. Bitcoin is the hurdle rate, and if you can beat Bitcoin, then here is a solid option in my humble opinion. But remember, this is not financial advice. This is financial entertainment. If you can't handle the volatility, you don't deserve to be here. Have a terrific day. Class dismissed.